Hi, my name's Debra and I'm from the Property Frontline.
Hi, my name's Ken from Avvora Finance. Thanks for joining us today with Property Mythbusters. And today, this session, we're going to talk about give you a quick market update, given the start of the new financial year, and also give a 6-month forecast on what our take is on the next 6 months on the property market. So I'll get right into it, Deb.
Mm-hmm.
All right, so I'm looking at the home loan side of things. It does seem that some of the banks with fixed rates have decided to reprice and increase their fixed rates. Does this mean that every other lender is going to increase their fixed rates? I'm not sure. There was one who went the opposite direction and decided to reduce their fixed rates. So that could be interesting to see how that kind of plays out. If just, I guess, a quick snapshot in terms of how the prices kind of get determined by banks. They kind of find sources of money. It could be from the RBA or it could be from other sources. They also have their own particular margins and targets that they're wanting, financial targets that they're wanting to hit. And depending on how many applications they're receiving for home loans could kind of dictate whether they increase or decrease their fixed rates. So as you can imagine, maybe a lender who does have cheap money ready to go, but they're not really seeing a lot of applications, they could potentially reduce their rates to kind of attract more applicants to them. If they're seeing too much, they could increase. There's that kind of dynamic. That's one factor, I guess, the supply and demand of the applicants and the money that the banks have that can determine the price of the home loan and the fixed rates. So that's just something to keep in mind. There are also risks in terms of fixing your rates, which I will mention briefly. There are break costs if you do decide to sell or refinance or pay out the loan for whatever reason. But it does give you that stability in terms of knowing how much the repayments will be for that fixed period. How is that for a summary for fixed rates, Deb?
Really good. Very good. Yeah.
The other item is we've seen a lot of home loan applications be primarily home buyers, people looking to buy their first home. That has been a pretty strong market. The demand for buyers or applicants are primarily looking at their first homes, but then there's also the people looking to upgrade, downgrade. Some lenders are seeing or kind of trying to look at investors and trying to provide some promotions to entice investors to take up an investment loan with them. So we'll see how that kind of plays out. Over the last 12 months, we did see since the start of last year, I should say, we saw the rental market kind of drop in terms of rents and things like that. So that could impact the return on investment, but that's changed since then. Deb, when was that? When did that kind of change or bottom out? Do you recall?
Are you talking about the rental market?
Yeah, when did it kind of find the bottom? Like 3 months ago, or?
Yeah, I would say it would have been around about April. But we're talking about the city-based rents that fell through the floor because the regional rents really increased. But so most investors would have been impacted by the city-based rents going down. But of course, now that has stabilised and is starting to strengthen.
Makes sense. So they are looking at potentially, the investors, and that could kind of come through later on when the market does bounce back, because we're going to talk a little bit about that. Not bounce back, I should say, probably like the activity in the property market, especially within New South Wales, given our lockdown. The last thing I would probably mention is just assessment timeframes. So the major banks, in particular, they were struggling with assessing all the applications, and some of the smaller banks as well. They've halted pre-approvals. Since then, with the majors, they've seen an improvement in the time it takes for them to assess the loan and give a decision. So that's a promising outlook in terms of, getting a approval head. To give you an idea, so one of the majors are sitting at around, or two of the majors are sitting around, the 4 or 5 working day period, which is reasonable. But we did see it blow out to, almost so six weeks, working weeks, so days,
There was
40 something days.
There was people who lost properties because they weren't pre-approved before they made their offer, and because the banks were taking so long, they had to pull out of deals. It was bad.
Yeah. So if you are kind of interested in looking at buying property in the near future, because what we have seen previously in the lockdown last year, I'm talking specifically within New South Wales, anyhow, being based in Sydney. So there was an increase in online property searches. Deb, was that right? An increase in property searches during lockdown. And that kind of then flowed on to the actual property market once, the lockdown restrictions came off. Everyone was kind of looking at purchasing. So it might be a good idea now, given, the assessment timeframes, the time for lenders to assess the loans are relatively low, or within reason, and there's not much applications going through. Now might be a good time to kind of consider getting that pre-approval in place. So because I think our anticipation here is that the property market, the activity is going to there's a couple of factors. The storm's quite right for a massive increase in activity once the restrictions come down, because not only from the previous lockdown we saw a pickup in activity and people buying activity, actual transactions happening, following on from the online searches. So there's intent to buy, and then that kind of flows on to actual going out there and buying property. But we are also kind of entering that typical spring season as well for property transactions. So it does look like the recipe's ripe, and it probably would make sense to kind of have a chat about your finances, get that in order, get the pre-approval sorted, so then you're able to kind of capitalize on any opportunities that kind of come on board, and skip the undue amount of time searching and looking and things like that, especially if you've missed one. If you're a first-time buyer, it is good to kind of, if you find a property that you like, to get on top of it, because in certain market conditions, once that property's gone, you might be looking for the next 6-12 months. So that's something, I guess, which might be something that Deb, you might want to talk about, but that's everything from me.
Okay, that sounds good. All right, so what I'll do quickly is just provide a market update of activity up until the 30th of June 2021. And as Ken was mentioning, after the lockdowns, we did notice this really huge increase in activity, which was obviously fueled by low interest rates and a bit of euphoria. But this graph, which realestate.com is starting to track, this shows market activity in January 2020. And so this is buyer demand, how much activity, what was the search rates like on their portal. And so by January 2020, we were coming into a bit of a frantic market, and this is where it started. And so market activity or search activity started to go up. Then this is the very first lockdown. So activity dropped for a couple of weeks and then bounded right back up. And if this was a hot market, what do you think this was? And so then we have the period where they're talking about Melbourne's lockdowns, and that sort of drew a little bit of activity down, but this is because we're looking at a national flow. If we did look at it state by state, you'd see New South Wales still really, really high, Queensland really, really high, and Western Australia. And then we had the natural dip in December, and then it bounded straight back up again. And so this takes us through to June, and the end of June, which was when the Sydney lockdown started to occur. So it'll be interesting to see, because this comes out weekly, it'll be interesting to see what actually happens. But, you know, if we're looking at mirroring the same response, we're expecting the market to stay very, very strong. Then this is rental demand. We won't talk about that too much, but as Ken mentioned, things did, we started to see rental activity decrease because we didn't have the amount of immigrants or immigration coming in. But so we had a natural dip in the party period of December, January, and then things started to trend downwards and then stabilise. With respect to housing prices, so this graph here on the left-hand side, this is from the RBA, the Reserve Bank deck of information where they make their decisions about what they're going to do with the cash rate. And so this actually tracks major houses that actually track pricing. CoreLogic, you know, like they're tracking what house prices are doing or what dwelling prices are doing. And there's 3 other organisations that do it. So the ABS, so the Australian Bureau of Statistics, and then these other 2 that we won't mention. But anyway, so in this graph, all 4 of those organisations that track pricing are combined onto the one, and so you can see they're all fairly consistent. And then 2016-17 dip, and then things started to recover. And then from here, 2017, this is where all the APRA restrictions and the really tightening of access to cash came in. So the government let that all occur. Then we had the Morrison federal election, and they let things rip again. So it did constrain activity a little bit, but then, you know, this is coming out of it and into recovery. Housing loan commitments, you can see, so this darker line on the bottom is investors, then orange is owner occupiers, and of course the combined total. But you can see the impacts of how the government incentives were really targeted at owner occupiers, and they were already on the front line, you know, twigging that they were getting really good prices for their current property. So there was a lot more upsizing, right-sizing going on, and a lot of refinancing, right, Ken? Then this is the research house that we love the most reliable forecaster for what's happening in the property market. And this is their tracking, SQM, of median prices for each of the different cities. So you can see here, it's easier if you look at the rolling month or the 12-month change. And you can see in Sydney, in the at the cutoff of the 30th of June, that there was, after that frenzy of buying, that there was a little bit of sense came back into the market, which was great for me. But, you know, basically most areas of the country are pretty much all green, which means prices are increasing. And this shows rent values. So this is the CoreLogic report, and shows how rental prices generally had decreased and then started to harden. And that would be a lot of it due to the regional changes. Yeah, these outliers of Darwin or Perth I'd pay attention to, but Darwin, like there's not that many properties in Darwin, so it doesn't take much to cause an increase. I know it can get a little bit boring. If you do
No,
want,
not at all.
no, if you do want this in more detail, I'm happy to send it out to people. Now, in each of the capital cities, generally trending upwards. So this on the left-hand side is Sydney, Melbourne, Brisbane and Adelaide. You can see they're all trending up. And Perth, Hobart, Darwin and the ACT. Perth, to me, had a slight dip in May. That's the history of it. And so what do we think is going to happen in the future? Every 12 months I do this little stats analysis that shows us really at a very high level what's actually going on. Suffice to say, we are expecting that buyer demand will still not be met by supply. So that means we're not having enough, we haven't got enough properties on the market for all the people that want to buy them. Statistically, what's changing, this graph here shows the number of people who have investment properties. This line here shows how many people own one property, then own 2, 3, 4, 5, 6 or more. What we did notice, because these stats, even though they're the latest stats available, and they're issued by the Australian Tax Office, the latest stats that came out in June were for the end of the tax year 2019, where we saw where it was like the hardest for investors to get money. And we actually did see some people changing their portfolio. But really, in summary, there's still an increase in the people who are buying property as an investment. So 18 to 19, there was about 20,000 more investors. How is the market generally? So across all of Australia, CoreLogic, who tracks this information, reports to us that there is about 10,600,000 dwellings. We've got 25,800,000 people living in Australia. So that means we've got around about 2.3 people living in each of our houses. But of course, that's not how it actually works out. But out of those 10, nearly 11 million dwellings, how much of it are they worth these days? CoreLogic says they're worth about 8.4 trillion, which is a lot of money. How much debt is against that 8.4 trillion? It's only 1.9 trillion. That gives us a collective loan to value ratio of 22%. So that is very low, and that's a very strong ownership base.
Yeah, one of the key factors that lenders kind of look at when they're assessing an application is LVR, loan to value ratio, and how that's worked out is, what is the size of the loan compared to the property worth? So if a property is worth $1 million and you're borrowing 800,000, the LVR is 80%. So you can have your loan amount divided by the property value. A higher LVR is usually an indicator of higher risk from a bank's perspective, because if they can't sell the property, the market's not doing too well, or there are other factors that kind of can impact the sale. Property generally is an illiquid asset, so if you were to borrow 100% of the property, a slight dip in the market would mean that the banks can't recoup the loan that they've given you, and it'd be a balance that they still need to chase after. But on the other side of the spectrum, if the loan amount is only 200,000 and the property is worth $1 million, odds are, even if they sell for half the price, everything will be cleared out. So that's something. LVRs are usually a risk indicator for banks, wanting to lend money. But
it does show the strength of the borrowing capacity of the person that owns the property. So as a collective, Australia has a really, really solid ownership base. Of course, that's at a very high level. But yeah, so thanks for that, Ken. I think I did. Okay. And I just want to rip through a couple more pieces of information. The other thing that's changed in the stats that we saw released in June was that in 2017, before the banks started tightening access to money, around about 75% of investors were negative gearing. So that means that they were the money that they received for their property was not covering all of their costs. But in 2019, now only 58% are negative gearing. So it's really getting the message through that it's actually better to buy a positively geared property. So one where the property is going to take care of itself as far as costs go, but also the drop in interest rate and the increase in rent meant it was actually like a done deal. Like a property that you might have bought that was going to be negatively geared because of the interest rate not having to pay out so much, it's automatically turned itself positive. But sort of a bit technical. Anyway, it covers, once again, something that I talked about only a few minutes ago. So there's a really huge, big jump in owner-occupiers and first-time buyers buying their property, whereas this one, portion of new lending for investment housing, kept going down, 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 and we're now only starting to see the start of the recovery. And this is where I think we're going to have all of the activity after this next period or this current period of lockdown. So investors who were pretty much couldn't get to their money because the banks were taking so long to do their refinancing or their applications, all of those guys are really starting to get organised just as the lockdown occurred. And now they're either sitting on their approvals or they're now just starting to get organised for their approvals. And they're going to be out there in full force once lockdown is over in the coming months, in relation to really what's coming down the pipeline. And this all comes down to supply and demand. From the demand side, we've got an increase in the population, just natural population. And of course, the government will be incentivising migration once lockdown is over. But over the next 10 years, the ABS, the Bureau of Stats, is projecting that we will collectively have about a 5 million person increase in the population. And so that means 5 million people. If we work on the ratio of around about 2.3 of those people needing housing, that means we'll need to create in the next 10 years 2.2 million homes. And are we doing that? No, we are not. So basically, supply is still not meeting demand. It's not meeting it right now. We're about 200 to 500,000 behind what we really need at the moment. That's another reason why prices are increasing, and so that means that the government's going to have to get more housing supply out there, otherwise prices are just going to increase. Do you have any questions or comments on that, Ken? Saying it was boring, that's all. Yeah, but I love looking at that really high level. Of course, everything changes once you actually look down, right on street level. Sometimes it's really good to take that step back. But anyway, so if you're all still awake and still here, thanks very much for watching. We'd love your feedback. So if you would like to suggest questions or topics that we can answer, just let us know. You can reach me at debra@frontline.com.au or Ken at ken8@avvora.com.au, and our websites and other contact details will be in the description section. Okay, alrighty. Bye-bye.
Bye.